Yo, what's up, everybody? Thursday, February 20th. I was a little bit concerned yesterday when I saw the data from the daily Treasury statement because I was anticipating the big surge in flows due to the quarterly interest payment. And there was a big surge in the leading flows. I think it was up something like 84 or 89 billion for the day. So that was big. But the net flow was only something like 34 billion. So an enormous amount of taxes drained out of that. And I went back and I looked at the last quarterly interest payment in November, and I looked at the quarterly interest payment in February 2024, and the net transfer was much higher. I think in February it was like 65 billion net transfer. I think in November it was 65 billion net transfer. I think last year in February 2024 it was like 72 or 75 billion net transfer. So, 34 billion, it made me a little bit concerned because, we're still hearing about all these Doge cuts and stuff like that. So I'm thinking, well, maybe this is finally starting to hit, because up until now, I haven't seen anything in these daily flows that would suggest any kind of a significant cutting. No cutting at all, really. I mean, the flows are on an upward trajectory, or at least I thought yesterday. But in today's Treasury statement, everything is back on track. So when the market was down heavy today, and actually, what I do is I use market correct. I don't go short anymore. I don't short the market. I mean, I've explained that so many times about my floor trader past, years in the pits. And all we did, most of us anyway, was sell. And the biggest guys, they were always buying. And they were always like, it would be one guy who would be like the predominant buyer in the pit. And then all of us independent traders, for some reason, we were always selling. I mean, I always said you could do like a really cool or interesting sociological thesis on this, like why, or psychological in that case. I said you could do a sociological thesis on the pit itself. Doesn't exist anymore, but the pit was like a microcosm of the world, of society. You had your strong, you had your weak, you had your followers, you had your leaders. So it was a fascinating environment to be in. Anyway, what I do when there's market corrections, or even in a recession or a bear market, I accumulate assets. I mean, the great thing about this country, and if you don't understand this by now, and it took me a very long time to realize this, is that this country is built as an ownership society, an ownership economy. And that's why they always say, like, you're not going to get rich working for a paycheck, but you get rich, and almost everybody on the list of the richest people in this country, or in the world for that matter, they're not rich because of a salary. They're rich because they own assets. And no country is more suited to that, is more set up for that than the United States. And I always said, like, the stock market is the greatest vehicle. I mean, real estate's a good vehicle, owning a business is a good vehicle, but the stock market is so simple. Here you have the opportunity to own little pieces of companies, great companies that have established themselves, that have a proven track record of profitability, maybe dividends even, innovation, leaders in their industries. I mean, it's an incredible, and plus you have liquidity in stocks. You don't necessarily have that in real estate. And you don't necessarily have that in a business. And it's unfortunate that a lot of you guys, you look at the stock market as, this thing has to pay me a wage every single day, right? You want to be in and out and in and out. And you think like, oh, this is so great because it's going to pay me a salary. It's going to pay me. That's absolutely the wrong way to use it. Absolutely the wrong way to use it. And the way to use it, I think, is the way that I use it. And, I'll be honest, it just kind of dawned on me later in my life, because I spent so many years as a trader, that you accumulate assets. So when the market goes down, I'm not looking to go short. I'm not looking to buy puts. I'm not looking to, buy inverse ETFs or anything like that. I'm not saying you shouldn't do it if that's your thing, but what I do is I look to buy good companies that people are panicking out of and they're selling, and I buy on the way down and I accumulate. And over time, you'd be surprised. Like I always say this to young people, if there's young people out there listening to this, and it's a shame that this is not taught in schools, because this is really the thing you need to know, and I've said it so many times, is that time makes you rich. Not timing, time makes you rich. And the earlier you can start accumulating assets, whatever that is. My vehicle is stocks. All right. I mean, but if it's real estate, if it's businesses, that's up to you. But I like the stock market because of its availability. It's basically 24/7. It's totally liquid. And, you don't get the leverage you do in real estate, where maybe you could put up 3 or 5% and the bank will lend you the rest. Maybe in some cases you put up nothing. With stocks, you put up 50%, the broker will lend you the other 50%, but it's still a great vehicle. So what I do in these down days is and I place my orders in advance. I don't jump in on a day. Sometimes I'll jump in on a day like today when it was down 500-600 points, and I'll put my limit orders, buy orders, at the low of the session. Whatever that session low was when we opened up, I'll put it just slightly below there, and I'll leave it there as a good until canceled order. If that gets filled, great. If it doesn't get filled, no big deal. I've used the analogy in the past, like you're going fishing. Anybody who likes fishing could understand this. You put bait on your hook, you cast your line out there, maybe you cast a few lines out there. You leave them out there. Hopefully you get a hit. If not, you go home, you had a great day. You go out the next day or the next week, you do the same thing. Same approach that I use here. I throw the line out. Those are my limit orders at lower levels. Sometimes I might even look at a chart, yes. And I'll put it below like a prior low, someplace that was like a fairly important low. And I'll put my order right below there because I know that there's going to be sell stops there and people are going to panic and they're going to sell out. So that's what I do. Anyway, it looks like, the flows are still trending higher. I do not see any evidence whatsoever of any cuts in the spending. Net government transfers, they have plateaued out, but they're not falling, okay? So that's a good thing. I'm still a little bit concerned about April and May of this year because, of course, we have April, which is the usual tax drain, April 15th. I mean, that's a temporary setback for the market. You get a drain. It takes time to build it back. By the summertime, we're off and running again. But this time you also have May 1st, which was the IRS tax extension for people in hurricane-affected areas last year. I'm one of them, okay? So May 1st, those filings and if payments need to be made. So there'll be another drain then. So you're going to get hit. I said this before, back-to-back, April 15th, May 1st. But until then, I think it's looking good. I think today looks to me like as long as these flows are trending higher, you got to be bullish on the market. And sentiment, when I look at sentiment, this week's AAII weekly sentiment survey, bulls are low, bears are high, neutrals are fairly high, I would say. That seems to be a mixture that would lean towards a further market rally. So anyway, yeah, that's it. That's it for today. And please like and subscribe and go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.